Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our experts then, Vivek Mawani and Sharmila Joshi, independent investment advisors, and Forum Parekh of Ventura Securities now joins us on the show. Many thanks to my guests for joining me today. Today on Hot Money, we'll discuss whether the SBI Cards IPO, which opens today, and if the analysts here are recommending subscribing it to it. We talk about a portfolio bet at these market levels. The Nifty is actually corrected significantly, and then we talk about one short-term bet that our guests are talking about that one should take, and finally a stock which has actually overvalued and probably if you have in your portfolio you should exit, or probably if it's in the F&O you should short that counter. But so that's something that we will discuss on Hot Money today. But the first one is important. SBI Cards obviously not listed, but the buzzword about what will happen, the grey market premium, which actually people believe have corrected significantly from the highs. But what should one do on SBI? If you're a retail investor, what's your take on the SBI card issue? Should you apply or should you not? Vivek, two questions. First of all, should you apply or not? And if you don't want a sizable chunk, even if it opens higher for a long-term bet, should they buy on the first day?
Three things. One is one should certainly apply. So whether it's a retail investor or an HNI investor, one should certainly apply for it. We don't know. It's too early to say what would be the oversubscription numbers be like, and hence what would be the allotment. Now, whether one should buy on the listing date would also depend upon what price it gets listed. As you mentioned in your opening remarks, the grey market premiums itself have fallen, and based on what the oversubscription numbers will be, will also determine what would be the funding cost, because this is going to be a highly leveraged IPO. A lot of HNI applications with huge amounts of leverage, and there are several banks and NBFCs offering leverage as high as my sense is even 40 times. So one pays just 2.5% of the application amount, 97.5% is funded. Obviously, so that would determine the funding cost and hence what it would get listed at. Having said that, after a long time, we are seeing an IPO which has so much of hype built around it, and usually too much of overhyped stocks or issues tend to disappoint in the medium to long term. Three things fundamentally about SBI Cards. Of course, the hype is about this is a unique business model, standalone credit cards business, which is outside of the bank. Otherwise, all credit card businesses is part of the retail banking. So HDFC Bank, which is the largest card issuer, or ICICI, Axis, Citibank, or you name any bank, it is a part of the retail banking operations. And obviously, there is overlap with the customers on the CASA side, current account and savings account. SBI is a unique, where 20 years ago when they started the business, they started off as an independent entity in joint venture with GE Capital. The optimism is also from a long growth runway that this business itself has. The sector in terms of credit cards, debit cards has given the very low penetration of less than 5% of the population. Here we are talking the banked population which has bank accounts, and population having bank accounts including Jan Dhan accounts is still just about 60% of the population having been covered by the formal banking sector. So the huge runway for growth is one reason for optimism. But obviously everybody knows the positive points. I'll just highlight three points to be cautious about. One is credit cards is an extremely profitable business and a very high ROE business. Now, we don't know whether regulation will permit the same level of profitability in future. There could possibly be some kind of a clampdown in terms of interest rates or fees and charges which credit card companies can charge. That would straight hit the bottom line, because the costs would remain the same. High operating leverage business, it cuts both ways in terms of if there is a shrinkage of margins and ROE, number one. Number two, in terms of innovations in the fintech space, one really doesn't know as to how things shape up in future. For all you know, we may not need credit cards, but yet have access to credit through online channels, or there could be standalone fintech companies who could also be providing consumer loans and stuff that say a Capital First and Bajaj Finance have got those innovations where even without a card you can still access consumer credit. To buy medium to high ticket items like white goods or consumer electronics or whatever it could be. Third, competition could drive margins and charges and fees down, given that there are a number of private banks who are already in that space, who are peripheral players, but would obviously have ambitions to scale up. So we don't know how these three factors may play up. Valuation wise, it's certainly not cheap. Last point, I'm never comfortable with any IPO where the promoters or strategic investors themselves are selling and basically getting us to buy their stock where they are profit booking. I mean, they as insiders probably know much more about the business, the future than we do. And so where the IPO proceeds don't go into the company for growth, but go into the pockets of the strategic and promoter investors, I'm never generally comfortable with those kind of IPOs. So medium to long term, I'll be cautious. Short term, because there's a hype, one should apply and look for listing gains.
Okay, that's the view that's coming in. Would you apply? Would you recommend anyone applying for SBI card?
So yes, and I would completely agree with Vivek that normally I'm very meaning I don't like offer for sale sort of issues, because I think that if you're doing an IPO, you should do it with a view that you use that money for something, that is to grow the business or some kind of a thing. But here it is obviously to give a exit to SBI as well as the other investors, so they're going to both partly sort of disinvest their stake in the company. But the reason why I think you like the IPO is 2-3 reasons. One is, of course, I think what you're also seeing is that there is a great fancy for like these sort of unique and new age sort of businesses where you're like we've seen the recent success story that an AFL has had, or the way people are now approaching Info Edge as a stock, or stocks like that. So where you think that there could be some business or technology involved, which we haven't seen in the traditional businesses so far, and I think SBI card sort of fits in that niche. And then again, I think clearly, if you look at the kind of credit card penetration that we have in our country, it is far lower than what you see in most countries, which suggests that there is a good room for the business to expand. Even if the other sort of payment options increase, there is going to be a market for credit cards, especially in the tier 2, tier 3 cities, where again SBI cards is focusing on going ahead. Again, I think if you look at the banks, whatever their numbers internally, what you've seen is that the credit card to the debit card sort of ratio that is there. For instance, HDFC Bank, which is the highest, which is the biggest credit card business, there the share of credit cards is higher than, say, there is in SBI cards, which means that they can mine their existing customers more who have accounts with State Bank of India, and they can cross-sell cards as a business to them. So that I think is something that they have been focusing on, and probably that whole what I mentioned earlier about tier 2, tier 3 cities, because that's obviously where they will target and they will try to sell their cards to. And I think thirdly, most importantly, if you look at credit card spending, that as a percentage, normally they take it as a percentage of your GDP, but overall if you take it as a how much people spend via credit cards, it's still a fairly small number as compared to what you see globally. So even if you say that yes, maybe overall spending in credit cards could come down, it still seems to suggest there is a good way for this kind of spending to go up in the country. So yes, I think it ticks the boxes. Yes, the grey market valuation has come down. We are in the middle of a sort of we don't know whether whether the coronavirus situation becomes a pandemic or not. So the fact remains, I think don't apply with leverage money, but definitely I think this is a subscribe, and I think you can keep the stock for a longer term.
Okay, and Forum, what's your sense? Apply for this? What have you studied on this one?
Yeah, so I also feel that one should apply for this because as we know, penetration-wise credit card in India is very low. I think barely 3% of the penetration is what is there in India, as against 300% that's there in US. And with the increasing, digitization and the changing lifestyle, I think anybody who possesses credit card, their spending is just increasing via the mode of credit card. So I think this phase will continue, and it is reflecting in the quarterly numbers also. If we see, I think the first half itself, PAT was higher than the last year's full year PAT for the SBI card. And if we look at the run rate, the company has been growing at 50% CAGR on a bottom line level. I think which is phenomenal, and only I think Bajaj Finance is someone, who's been growing at such 40% run rate. So I think given the fact that premium valuations are there, it is there to be there for a long time. And the kind of monopoly it enjoys in the listing space, I feel it will continue to hold this kind of premium valuations. And certainly if one has missed, in the IPO subscription, they should go and buy during the listing day as well, because the financials are going to be there. It is a high yielding business. NIMs are like at 16%. So I feel on every parameter, being an SBI subsidiary, good financials, and given the fact that credit card penetration is less, so there is all good parameters over here, and therefore I feel one should definitely buy.
Okay, so it's a 3-on-3 thumbs up for SBI card. So if you are an investor, apply for the IPO as per our guest. Remember, today is the first day. You still have 2 more days if you haven't done it yet. So that's the view that's coming in. The second one is that the market is extremely volatile. Today it's managed to rebound, but Friday was a big carnage and the Nifty's corrected significantly. Not only this, while most of the quality stocks had run up, they also managed to correct over the past few days. So we're asking our guest in this correction, which are the stocks that they are recommending to their clients as a portfolio bet that, buy probably could be a SIP basis, but buy and keep this stock in your portfolio. Sharmila, in this fall, obviously some of your clients must have called you and asked you which are the stocks that we need to add now. So which were some of them that you told them to accumulate?
So yes, as you said, this is prior to today's market, because today everything is up 5%. So this was really more last week when we were in the middle of all the concern, and I'm beginning to think that it's time to look at the auto space again.
Okay.
So I think Scots has had a too big a run up today, given the fact that Rabi crop is good, etc. And you are expecting better tractor sales, etc.
So the monthly numbers
were good. But I think also probably Maruti is worth a look at this price. And again, I think as you suggested, do an SIP and try and buy it closer to 6,000 levels if you can. Because as we saw this, on the weekend we got the numbers and they're sort of flattish, little lower than what they were last year. And that is actually the story that I'm expecting to see play out in passenger vehicles going ahead, because now this downturn has been on for over about between 15 to 18 months. So hopefully, once this BS6 is launched in 1st April 2020, you have a month now to clear that BS4 inventory, and from there on I think we will start seeing numbers stabilize. And I think if you look at it from a numbers perspective and everything, probably Maruti is the strongest name in the passenger vehicle space. So this is a stock that you could look at, and again, to reiterate, as you said, try and do an SIP, and hopefully this should give you good returns from current levels.
Okay, Forum, which is stocks that you've told your clients now is the time to start accumulating?
So I feel ICICI Bank is something that we should accumulate, and in every falls we should accumulate, because we have seen for quite 2 to 3 quarters in a row earnings have been improving, asset quality has been improving and fairly stabilized. Those slippages were high, but then from the wholesale business they were like on account of some retail side, so which was I think again discounted, though the retail side slippages were not discounted, but then again we feel that it will come down going forward. Also, if we look at the retail loan book growth, it is growing at like 19-20%, which is very good as far as the industry retail loan growth book is concerned. And purely on the basis of valuation perspective, I like ICICI Bank, because amongst all the retail private sector banks, if we see Kotak, HDFC, all are trading near like 4 times price to book, whereas this one performing quite good in 2 to 3 quarters in a row is trading at like 2.5 something at price to book. So looking at the valuation perspective, I think there is a long way to go. There's a lot of room for upside, and therefore I feel that looking at stabilizing in the asset quality, one should definitely look to buy ICICI Bank on every correction.
Okay, Maruti, ICICI Bank, which one have you told your clients you like to start accumulating?
Yeah, so I'm going to talk about 2 sets. One is briefly, we discussed large cap IT last week itself. Curiously, on Friday, rupee weakened significantly, and so generally a weak rupee would have meant good tidings for the technology space, given that they derive practically 100% of their earnings in dollars. But Infosys and TCS were down 4-5% even on Friday, on a day when rupee itself weakened substantially. So continuation to last week, would continue to accumulate TCS and Infosys. However, a different stock that we should be talking about. So for me, it's Bharat Electronics, which has corrected almost 25% in the last couple of months from 100 levels to about 75 levels. While everything remains very strong for the company, a very strong order book of 56,000 crores, which will ensure about 18 to 20% growth for the next 3 to 4 years, with pretty much assured margins, free cash flow, return on equity of about 18 to 20%. Now, and they have a debt-free balance sheet with surplus cash of almost 1,800 crores sitting on the balance sheet as of September end. In the next 3 years or 4 years, they would generate another incremental free cash flows of almost 5,000 crores on a current market cap of about 18,000 crores. 2 years back in February of 18, they had done a buyback at 181 rupees per share, and right now the stock price is about 75, 77. Dividend yield of almost 5%, 4 or 5%. I mean, they have yet to announce an interim dividend, but if I were to go by last year's trend and growth in profit, that's what it trades at. So my sense is from 75 levels, downside is pretty limited and can be a good medium to long-term holding. Valuation wise, it's just about 12 times current year earnings, about 10 times 1 year forward earnings. So for me, it's Bharat Electronics besides large cap IT.
Okay, so Maruti, ICICI Bank and Bharat Electronics and some of the large cap IT stocks have been spoken about. These are the stocks that you need to hold in your portfolio as a positional basis, not a short-term basis. Now, interestingly, when the Nifty itself is moving 4-5% in a day, it won't be surprising for some of the stocks to gain 15-20% in the very short term. So we're also asking our guest to name some stocks they believe probably they may be beaten down, probably there will be some reason they believe can move much faster and hold for a short-term perspective. And by short-term, we mean 3 to 5 months, not a 3 to 5 day, but some stocks probably may move that time also. From any stock that you believe that in the short term, okay, this is the stock that you need to hold.
Yeah, so I like Escorts, and today we see it's already 10% up. So looking at the financials, I mean, though it had reported muted set of numbers because the entire industry was down, but the monthly volume growth has been growing quite good. Today also we saw, volume data has come quite robust, and I think Mahindra did not report good set of numbers, but Escort in the tractor space has reported good volume numbers. So that is growing. Market share in the agricultural tractor segment is growing. Again, their railway segment is doing quite good, though it is just I think 10 to 15% of the total revenue, but then that is increasing, and the construction business, which is the second largest, is declining. So Escort, I feel in a long term also it can give you a good returns, as well as in short term also it is a good buy. So Escort being a good management and good corporate governance stock with increasing market share, and now industry is also picking up, with the kind of rural spend and income being increased because of higher MSPs. So I feel agriculture sector would do good, and therefore Escort is something that one can buy both from short term as well as long term perspective.
Okay, Vivek, anything on the short term perspective side that you told your client to accumulate?
Yeah, so Adani Gas accumulated, nibbled a little bit on Friday. Now Adani Gas until a couple of weeks ago was trading at 180, 190 levels, and on Friday it had fallen to 125. Not that it fell only on Friday, it had been grinding down last couple of weeks, and on Friday it hit 125. Friday also there was a large block deal between Adani Group having sold some part of the holding to Total SA of France, which has already taken a strategic stake in Adani Gas a couple of months ago. So I think the block deal was about 5,000 crores in Adani Gas on Friday. The stock has of course recovered to now it's about 140 between Friday afternoon and today. So what I'm referring to is that the stock has corrected sharply in the last 2 weeks. My sense is it could possibly bounce back to 170, 180 or 190 levels that it was about a few weeks ago. Nothing really has changed in terms of new round of gas licenses. Adani Gas has got the maximum number, 45 cities or 45 territories, whatever you may call it, which they are jointly with the Total going to be laying out the infrastructure. And so one is expansion to 45 cities, where the revenues will start kicking in the next 1 or 2 years as the infrastructure starts to be put into action or put on stream. And the growth runway for these 45 cities alone itself will ensure growth for the next 10 to 12 or 15 years in terms of volumes. Not to say that in between there could be more cities and territories coming up for licenses, and Adani Gas could probably get some of those also. Valuations may seem expensive at about 30 times current year earnings, which is a premium even to Indraprasth Gas, or significant premium to Mahanagar Gas or Gujarat Gas also. But none of them have so many more licenses, so the growth opportunity for Adani Gas is also so much higher. So at about 140, I would accumulate Adani Gas.
Okay, Adani Gas is something that's been spoken about. Adani Gas Escort, which is the stock that you've told your clients.
So, obviously there's a whole situation in China, which is why one certain segment of stocks are benefiting. And I think one obvious sector has been that whole chemical, fluorine and pigment sort of space. But I'm looking at something else which is sort of benefiting from the situation developing in China, but not directly linked, and that would be paints. Because what we're really seeing is a big correction on crude. So now we already have crude closer to $50, and I think if you, even if you see a recovery in this whole coronavirus situation, which according to me is not so easy to happen, that is going to take its time to play out. So I think crude prices in the meantime are going to stay depressed, because it's going to take a while for things to sort of get back on track. And I think the obvious beneficiary is going to be the paint companies. I've gone with Berger, but I think Kansai Nerolac is also a good name to look at in that space. Simply because, the direct benefit is going to come to the bottom line, and I think next quarter they are going to have a fairly good, strong quarter, given that their bottom line is going to reflect that. This could be a play on lower crude prices, and as you said, with a 5 to 8 month sort of an horizon, Berger Paints is a stock you would look at.
Okay, so paints as a segment is something that's been spoken about by Sharmila. And finally, we are talking about things on the long side. No doubt that the market is corrected, but still some of the stocks are still trading at premium valuation. Some of the large quality stocks have also probably not corrected. So one stock which we are asking our guests if they believe probably can correct, not only because there's something wrong with them, it could be based on valuation, it could be the run up. So we're asking if it's an FNO short, someone could go short. If it's in your portfolio stock, some of them need to book their profits here. But Vivek, which is the stock that you believe probably now probably is overvalued and can now start seeing correction?
Well, so actually, to answer your question, which are the stocks which can fall? Oh, there are a whole lot of stocks. Probably there are a couple of hundred stocks which still deserve to fall much more than what they have fallen in the last week or more so on Friday. But one of the stocks that I'm concerned about is IndusInd Bank. We have discussed Indus. I mean, you would recollect we had discussed IndusInd Bank a few months ago, or maybe last year, sometime in 2019, where I had laid out concerns on their accounting and the quality of the book. Though concerns still remain, it leaves much to be desired on part of IndusInd Bank. That time the stock price was about 1500. It's corrected about more than 20-25% subsequently, but the concerns still remain. So three things basically in terms of concerns. Although they have reported gross NPAs and net NPAs of 2.18% and about 1% net NPAs as of December end, three large accounts, which is a foregone conclusion that they have to be NPAs, which is where they talk of a media group, they talk of a housing finance company and a diversified conglomerate, obviously reference being made to ZSL Group, ADAG and Diwan Housing. IndusInd, the exposure of their total book is more than 1%, about 1.2%, and they still consider it a standard asset, which probably beats all logic, because most mutual funds, most other lenders have taken provisions or taken write-offs on these three, and IndusInd thinks that this is still a standard asset simply because they think that they have collateral to cover it. My problem with the collateral is you try to encash it, they will probably not be able to realize far from 100%. They'll not. It'll be a fraction of what the exposure is. NCLT, we know how frustratingly painful it is to make any recovery. So far, only there's been only one recovery so far of hundreds of cases in NCLT. That's number one. Number two, moreover, the exposure to the troubled sectors, telecom, real estate, NBFCs, you name it. I mean, if I were to name the top 5 sectors which are troubled, IndusInd Bank has exposure of another maybe close to 15%, all these sectors put together. I'm not saying all of that will become NPAs, even part of them become NPAs. Suddenly your 2% gross NPA could jump to 5% before we even know it. Third, even for underreported NPAs, I'm using the word they, I think they are underreporting the NPAs. their provision coverage is only 54%, which is also much lower. I mean, most PSU banks have it upwards of 70%. Most private banks have it upwards of 75%.
Okay, Vivek, I need to stop you because we're running out of time and I need to ask the other guests also. So IndusInd Bank probably, with the points that Vivek put, is making a point here. Sharmila, what's your sense with stock?
Yeah, so I mean, today we are seeing a bounce back, but I think a sector that's at risk is the metal sector, because I think even if this coronavirus situation sorts itself out, I think it's going to be some time before we see a recovery in that sector, because you require things to be a little more stable globally for you to see consumption of metals go up. So yes, the valuations are in favor of metals, but I think that if you see this whole concern on coronavirus re-emerge, you could see lower levels on metals.
And which is the most vulnerable stocks in the metal space?
Probably Tata Steel, because it has exposure to both Europe as well as geographies outside. Hindalco could be one, and I think JSPL.
Okay, and Forum, which according to you are valued stock?
So I don't like ITC, not because of the valuation perspective, but because of increasing awareness of ESG concept globally. So if we look at ESG index also, I don't think so there's inclusion of ITC stock in the ESG index, and Nifty ESG index has always given higher returns than the Nifty normal index. So I think with the rising awareness also, ITC wouldn't be doing good. I mean, it is not performing earnings wise. That is one whole another story. But if you look at money flowing in the ESG kind of stocks, money I do not think flowing in for ITC, and even FIs, if we see for the past 4-5 quarters in a row, they are declining their stake. I think from 17% it has come down to 15%. So with the rising awareness further, I think ITC can take a hit even more, and therefore we do not like ITC even at current levels.
Okay, so ITC metals are some of the counters, IndusInd Bank are some of the counters that you need to watch out for if you have in your portfolio. But with that, it's a wrap on this edition of Hot Money. Let me thank my guests who've come in today, Vivek, Sharmila and Forum. Thank you so much for coming in today. Ask BQ comes up next. Stay tuned to BloombergQuint.